sponsored by the Securities and Exchange Commission of Nigeria.
Welcome, you're watching Eye on Nigeria's capital market. I'm Esther Ubodaga. Thanks for joining me. Our focus on this month's episode is on collective investment schemes. We'll see why stakeholders such as the Securities and Exchange Commission continue to emphasize the importance of this industry. But first up, we'll bring you a quick wrap-up of the just concluded Capital Market Committee meeting, the CMC. It wasn't business as usual this time around, as the CMC took time to participate in Nigeria's ongoing Centenary celebrations. This is the first Capital Market Committee meeting for 2014. Every quarter, the apex regulator brings together market operators and other stakeholders to consider reforms that can drive the growth and development of the capital market. It's also a forum for market players to get feedback on issues highlighted at previous meetings.
So we thought we'll dedicate this meeting primarily to get a sense of where we are, because we think that the master plans are very, very critical for Nigeria and for us to be able to determine how we move forward over the next 10 years in terms of how the capital markets can really help enable Nigeria realize its potential.
A review of a 10-year plan to drive growth and development of the capital market is the main business of the day.
What we did in September last year was to set up 3 committees of the Capital Markets Committee. One of them would focus on developing a plan for the Nigerian capital markets over the next 10 years. What do we want to become in the next 10 years? And that particular committee shared with us today that based on their findings, what they would recommend for us is to move from having a market that has a market cap of 27% of GDP to one that's 130% of GDP. That is aspirational, it's ambitious, but they've also outlined how they think we can achieve this. So that's one committee. The second committee is called the Capital Market Literacy Master Plan Committee. We've identified literacy as an enabler of really getting our markets to where it should be. And this Master Plan Committee is focused on how to segment the market, how to make sure that in an efficient and an effective manner, we're able to deliver financial literacy to all segments of the population of Nigeria. It's very similar to what's happening globally. Most people feel that one of the reasons that the global financial crisis hit the world in the way that it hit was that there was not as much attention being given to issues of literacy. It's also something that is shared amongst the regulators in Nigeria. The central bank chairs a committee of us all regulators, where we're also looking at how we can reconcile the work that we do with respect to financial literacy. So the timing is perfect because it's very well coordinated with the broader initiatives of capital markets regulators globally, but also of regulators in Nigeria. The third one is focused on, it's called the Non-Interest Capital Market Product Master Plan Committee. We've identified that non-interest products is a key area of growth. When we looked at other jurisdictions, we saw the fillip that the non-interest product gave to them. We think it's important for financial inclusion. We think it's important for inspiring innovation. So that other committee is very focused on this. We expect that significant progress will be made in the not so distant future. And what we hope is that these 3 plans will guide how we deliver on the promise of a capital market that is world-class, that is one of the top 20 in the world over the next 10 years.
At the press briefing right after the meeting, journalists interact with the SEC and other key market players.
We discovered that there is a dearth of knowledge of the capital market in the population. Presently, from our records, 3 million to 3.5 million Nigerians only participate in the capital market out of a population of 160 or 170 million. And that is so insignificant. So our committee is trying to find out why this is so. And one of the reasons is lack of knowledge. So the committee is to come up with ways of informing at least 40 million Nigerians in 10 years and getting 25% of that amount to participate actively in the capital market. So that is our mandate.
Our mission is to ensure that in the next 10 years, the Nigerian capital market is ranked among the top 20 capital markets in the world. Is it achievable? Yes, it's achievable. What are the numbers are we looking at? We are looking at the capital market, the market capitalization contributing about 130% over our country's GDP. Has it been done in other countries? Yes. In Malaysia, they have 270%. In India, they have 150%. What do we have now? We have 27%. So which means we have a lot of work to do.
These committees were constituted by CMC with a mandate to go into certain areas that were defined in the various terms of reference. As the name suggests, even though others may call it, is it Islamic finance, some call it non-interest, some call it alternative product. But I think for the purpose of this assignment, we adopted the non-interest capital market product committee. We have done a lot of work, and because of the nature of our job, which may not be restricted to the capital market alone, I think the committee co-opted members from other sister agencies, like the Central Bank, NICOM, PENCOM, NDIC, and we intend getting people from others. We equally co-opted experts in these areas that were not originally members of the committee to assist us in the performance of our job.
We're measuring the market more in terms of value of shares that are materialized rather than looking at the total share capitals of companies that are introduced to trade on the OTC market. So in terms of value of shares that have been dematerialized and available to trade on the system, we now have about 6 billion in value, 6 billion naira worth of shares that have been dematerialized and are available to trade on the system. We expect that this will continue to grow as more people start converting from paper certificates to digital form.
A number of you may have heard a lot or seen a lot recently about X-Whistle. And what X-Whistle is simply a portal, a website, where people who have tips about infractions in the market can submit those tips anonymously. So you don't have to leave any details at all. You just submit it anonymously. Then behind the scenes, we have a team of people within the exchange who will go, investigate, and if it's got legs, then we will actually take this forward. And that could be taken forward as an issue that can be resolved by the exchange amongst its brokers, escalated to SEC, or escalated to any other appropriate party as well. We think this is a very, very critical building block in terms of making sure that we operate a well-regulated market that is transparent and takes a zero-tolerance approach to market infractions.
After the serious business was over, it was time to join in the ongoing nationwide Centenary celebrations to mark Nigeria's 100 years as a nation. The SEC choral singing group delivered a special production.
And let's come together, unite, and make something out of our nation. We are asking, what kind of country are we leaving behind for generations to come?
We decided that this particular meeting, the first meeting of the capital markets community, will be dedicated to celebrating Nigeria's centenary. We had the SEC choir that presented a unity song reminding us of the great country Nigeria and our role as individual Nigerians to contribute to making a difference through Nigeria. We also presented the Centenary edition of Monopoly, which has been promoted by Best Man Games. We're very excited that amongst the areas on the board, that SEC is one of those that's represented on the board. We believe that Monopoly is known worldwide as a family game that is fun, but also one that promotes financial literacy. And we believe that it's a way for us to promote our financial literacy agenda. So we're very excited to be a part of Nigeria's celebration of the Centenary. We know that there have been challenges over the years, but there's a lot to celebrate, particularly Nigeria's strength in its diversity.
Our country, our country, we must leave a solid legacy.
After the break, Nigeria's collective schemes industry has been in existence for over 20 years. However, it only accounts for 0.2% of the country's GDP. We'll look at what industry stakeholders are doing to change this. Welcome back. Despite the potential of Nigeria's collective schemes industry, most Nigerians still prefer to invest their monies in commercial banks, which offer lower rates on their investment rather than a wide range of collective investment schemes on offer.
The question that we need to ask ourselves is whether they're getting value for those savings. The banks are not going to like what I say, but we need to diversify that savings base. Where you find them within the banks is possibly within a savings account is short term. But what a collective investment scheme does, you can actually dimension different kinds of savings into short term, medium term, and long term. There are some products out there. We do need to diversify and expand the product base that we have. But to only have less than 300,000 unit holders in the 52 collective investment schemes in Nigeria is abysmal.
We've seen some studies in which industry UM is compared to banking sector deposits. In the US, it's over 100%. In India, it's approximately 10%. In Nigeria, we're like 0.1. So the industry is at its infancy. Even if you look at absolute population point of view, there are approximately 300,000 investors in CIS products, compared to a population of 170 million.
For the individual, collective investment schemes are a critical way to create wealth because you can take advantage of professional managers, their expertise, to access different segments of the market with not as much money as if you were investing yourself directly in the market. For the capital markets, it institutionalizes the market because the pool of funds that are put together can then be invested in one block. It enhances liquidity and enhances the quality of the market. For a nation, and for us, Nigeria particularly, which is something that is important to us at SEC, it accelerates wealth distribution because then people can very easily access the market. And that's critical for social cohesion.
A number of factors are responsible for this trend, and key amongst them is lack of knowledge.
There's also a high level of distrust in Nigeria in the sense that people are not sure who they can actually trust with their hard-earned money. So I think the thing to make people aware is that there's an industry. It's a regulated industry by the Securities and Exchange Commission. There are registered fund managers that can be held to account and licensed to basically, handle money. There are safety mechanisms and checks and balances inbuilt. There are custodians that will also, trustees as well. So there's a governance process. So I think once people are aware, they will trust. Then I think the third thing was that most people's idea of investing is synonymous to investing in the stock market. And I think that the global financial crisis, hurt the average investor quite badly, especially those people that were overextended and were hoping to make, very high returns within very short periods of time. And so because of that, painful experience, a lot of people are now somewhat scared that, oh, this is, a market, I can potentially lose all my money, it's synonymous to gambling.
Lackluster uptake is an ongoing challenge for the industry stakeholders who believe there's a lot the Nigerian market can learn about the benefits of collective investment schemes from other emerging markets.
My favorite example is India. When you go to India, their assets under management runs into trillions, and the number of schemes, hundreds. Same thing South Africa and most other emerging markets. And why is that? That is because there is a lot of literacy, there's a lot of awareness, there's a lot of confidence in their market. So the major thing we now learn from those markets is that there must be a financial literacy program among the various cadres, various target groups, from the women to the children to the adults to different sections of the population, for them to understand that mutual funds are existing. When you go to those jurisdictions, they do enlightenment in a big way. They do it on the media, they do it through print and electronic media. They have a lot of pamphlets, they have a lot of handouts, they have distribution channels all over the place, and they have investment advisors telling people all about mutual funds. So, we have not yet started. We need to do a lot of that. We've done a bit of enlightenment, but we need to go into the rural areas. We need to go to outside the cities and let people understand what mutual funds are all about, collective investment schemes are all about.
But perhaps a number of incentives, if introduced, could make CIS schemes more attractive to potential investors.
Regulatory fiat is generally not the best way to achieve such objectives. It'd be more of an incentive point of view to make mutual funds or collective investment schemes attractive. And that's what FMAN is working on. That's what SEC, also the Collective Investment Scheme Department of SEC, is also preaching. So it's really an awareness thing. The value proposition of collective investment scheme products are clear. For investors to be able to embrace and appreciate these products, there needs to be that awareness. So it's not really much of saying you must go this way or you must go that way. It's letting investors understand the benefits of those products, and then we'll see that gradual shift into collective investment schemes.
What we're saying is that there also should be incentive for people, because not everybody will have enough for their retirement. Despite the fact that some people, the law or the pension reform has started mid-career, might find out that they don't have enough towards retirement, or they can't maintain the lifestyle. So it's extremely important that the government encourages people to also try to augment that with other saving mechanisms or vehicles. And we think that, that then starts to build a social safety net, whereby people are not reliant on their children because they build up a savings pool whilst they were working, aside from their pension, because you can only draw on your pension specifically for retirement.
It hasn't been all doom and gloom for fund managers. In the last 15 months, growth trends have been noted.
For instance, we use net asset value as our indicator. From about 104.9 billion February 2012, we can see that it has grown tremendously to about 169.40 billion naira in terms of assets under management. In terms of number, we presently have close to about 53 collective investment schemes, as opposed to much less in 2012. The number of unit holders patronizing these schemes has also increased, but we're not yet there.
To make these recent achievements count, the industry is tackling the challenges head-on.
What the SEC has focused on essentially is, first of all, to strengthen the regulatory framework. The second thing is to draw attention to the value of collective investment schemes. You'll note that since 2010, we've essentially been encouraging retail investors to look at it as an alternative route to invest. That has led to us accumulating about $1 billion equivalent in terms of assets under management. There are about 52 fund managers 52 funds, and whether it be equity, bonds, a balanced fund, and other types. So there are a variety of funds today.
I think another thing that we touched upon is that we find out that for most of the collective investment schemes, the minimum might be beyond the average person. But the fact is that Nigerians are actually also getting wealthier. There's a burgeoning middle class that can afford to, but you still find that some collective investment schemes, the entry point is a bit high. And just because the operations of the schemes can be, expensive, especially if they don't have critical mass. It's easier to bring down fees and, ancillary costs. Also, what we noted is that to actually launch a fund in Nigeria is a lot more expensive than in other climates. So that in itself acts as a bit of a disincentive because managers will have to engage all sorts of professional parties. And I think what SEC has done is that, we've actually engaged SEC, we've discussed the strategy, and SEC has actually, reverted with a willingness to actually support that strategy.
The SEC's 10-year master plan provides a blueprint for growth. In addition, an association of fund managers, FMAN, has also come up with an additional 5-year plan.
Over the next few years, we'll ensure that regulation is updated. We would ensure that the industry grows from the 165 billion. We haven't really set a financial target, but we know we can build it into a multi-trillion naira industry.
The whole idea is that in another 5 years' time, we want to have a trillion naira collective investment scheme industry. So it's an ambitious target, but we think that it's very, very possible.
What SEC has done last year was to inaugurate 3 separate committees, I believe, to look at our markets, look at other emerging markets, and come up with a blueprint on how our market can be competitive. So the SEC committee is looking at the master plan from a broader capital market point of view, and I'm sure some of the initiatives they're going to be considering are some of the proposals that are in the fund manager master plan. And really, it's the same issues. When you look at global competitiveness, you're looking at the depth of the products that you have, which is some of the things that FMAN is trying to address. You're looking at the cost of the products that you have. You're looking at the regulatory framework. You're looking at the use of technology.
I'm very excited about what that particular plan will do if we implement it well. It will basically create a multi-trillion naira industry.
The fund managers say that their plan is designed to complement the SEC's market development plan.
Very simply, the objectives are the same. The 5-year master plan is the Fund Managers Association sitting down to look at how we can grow our industry in the next 5 years. What SEC has done last year was to inaugurate 3 separate committees, I believe, to look at our markets, look at other emerging markets, and come up with a blueprint on how our market can be competitive. So the SEC committee is looking at the master plan from a broader capital market point of view, and I'm sure some of the initiatives they're going to be considering are some of the proposals that are in the fund manager master plan.
Key to the success of these development strategies is a proliferation of investment products.
90% of the equity market is controlled by the top 40 companies. Even within those top 40 companies, the liquidity is not that great. Right now, I know the NSC is trying to deepen liquidity and so on and so forth. But what you find within the market is you will find the same number of people buying the same number of stocks. If, like the US, where at least there's the S&P 500, on the American exchange you have over 10,000 stocks, on the London Stock Exchange you have over 4,000 stocks, you can come up with different products where you have an equity fund, for example. You may have a large cap mutual fund, a mid-cap mutual fund, a small cap mutual fund, a micro-cap mutual fund, or they have the alternative investment market, and so on and so forth. Here, we don't yet have that. And so as our markets continue to deepen and broaden, you will find that products do come into the market.
It will be difficult for you to offer products that the ecosystem does not support. So you can't offer, for instance, products that are derivative-based, for instance, just because there are no rules, there are no regulations yet written. The exchange is just getting ready for that. You can't do things like, futures, for instance, or forwards, or things, very sophisticated. We now have ETFs, so we're moving in the right direction, which, is supposed to be like, well, what I like to simplify it is, mutual funds that you can trade intraday. It's very liquid, very low-cost funds.
With stakeholders committed to the development of this industry, significant growth is expected in the not-too-distant future.
The potential is even much more compelling. If you take, for example, the 4.5 million investors who have been contributing regularly over the last 7 years to their retirement savings account. If any of them contributed about $200 annually, we could essentially have more than $1 billion under management for the mutual fund industry. So the potential is enormous, and we think that it is important that we ourselves, the Fund Management Association of Nigeria, that we all pay attention to this particular sector. And the backbone, of course, has to be a very stringent regulatory environment.
With an annual population growth of 0.28% and rising disposable income, particularly among the middle class, stakeholders hope that more Nigerians will embrace and develop a culture of investing through collective investment schemes. The success of reforms in Nigeria's pensions sector gives some room for optimism. I'm Esther Obodaga for CNBC Africa.